Welcome to episode 14, George Soros, Part 3, 5 Trading Rules for Defense. Here's the outline of episode 14. Part 1, the 5 reasons to play great defense. Part 2, 5 trading rules for defense. Reason number 1 for playing great defense. The annual mortality rate of hedge fund is about 10%. And even the biggest of hedge funds, such as the Tiger Fund of Julian Robertson, is no exception. In the coming interview, Julian Robertson did not mention anything about risk or caution.
You are one of the greatest investors and money managers out there. You're also one of the best executive recruiters I've ever met. When I look at the number of funds that you've started that are incredibly successful, obviously you were very good at picking out talent. What did you look for in people when you were hiring them?
One of the most important things with hedge fund managers are that they are smart and that they are honest. And close behind that is probably competitiveness. We really like competitors. Someone who won't lose doesn't lose.
Reason number 2, George Soros is famous for making big bets and also using leverage. Reason number 3, George Soros is the father of fast investing. So what is fast investing? For most of Wall Street, investing means spending hundreds of hours investigating and researching through spreadsheets and data. Not for Soros. He usually spends 4 hours. That is why Soros has so much time to do his other activities, which I cover in the previous video, number 13. Here, Soros gave an example of speculating on Indonesian timber. He said in 4 hours, he became an instant expert and started to put his money to action. This is one of Soros' most famous saying: invest first, investigate later. Reason number 4, missing the danger. For example, Victor Niederhoffer, who was a partner with Soros from 1982 to 1990. In 1997, he lost $130 million in one day. It took him 20 years of trading to earn $130 million. Here's a picture of Victor Niederhoffer. Reason number 5, Soros himself is not immune to large losses.
You saw the crash coming in the late 80s, in 87, and yet you got caught like everyone else. How do you explain that?
I made a very big mistake because I expected the crash to come in Japan, and I was prepared for that, and it would have given me an opportunity to prepare for the follow-up in this country, and actually it occurred on Wall Street and not in Japan. So I was wrong.
Some estimate that that mistake cost Soros $650 million.
In 1998, Soros invested in Russia and lost $2 billion. He miscalculated the coming crisis.
Like risking $2 billion in Russia. When the Russian market began falling apart in August, Soros was the country's single largest investor. A few words from Soros were enough to cause panic selling that fueled the crash.
It looks to me like in a number of situations you can take a position against a currency or make a statement, and the whole country falls apart.
Well, it's a tremendous sense of responsibility, actually. And it's also a humbling experience because I am actually trying to do the right thing, and sometimes what I do has an unintended negative consequence, as it did in Russia.
For both the Russian middle class and for Soros, who lost his $2 billion.
Part 2, Soros' 5 trading rules for defense. Rule number 1, expect the unexpected.
War gave me a lesson I've never forgotten. What was the lesson?
The main lesson that I learned during the war is to expect the unexpected. I mean, the situations that you get into are so out of context with what you have grown up with that you have to examine the the framework in which you think. And then you realize that we all work with preconceived ideas. And those ideas don't necessarily correspond to reality. So there is this gap between perception and reality. And that's the gap that I have really kind of explored and also exploited.
Rule number 2, to survive in the financial market, make a hasty retreat if you're wrong. Rule number 3, develop a thesis and test for validity. In other words, start small. Rule number 4, when taking risks, don't bet the ranch. Rule number 5, how and when to leverage or deleverage. Only use profit to leverage up during good times and deleverage in bad times quickly to protect the principal.
So of course I'm involved. You constantly re-examine what you're doing wrong, and you slowly you tentatively get things right, but you can't really get the dynamic going until you have a little profit under your belt, because it's very different when you're risking your principal than when you're risking your profit. So that's how you get these runs, when you get it right, and then you can risk more and make more money. When you have lost it, when you are doing poorly, you've got to retrench. And even as you get it right, you don't get the performance until you can do it on a larger scale, because risking your profit, you see, is much easier.
It's less terrifying than risking your principal.
Yeah, I mean, the reason we have such a good record is because we never lose our principal. Once we are in a bad position, we retrench. So we might lose a little bit, but we'll never endanger
because you leverage well.
That's right. We deleverage when we are not making money.
You stop.
What have I learned today? The 5 Trading Rules for Defense by George Soros. Playing great defense ensure long-term survival. Thank you for watching. Please subscribe and leave your comments and questions below. I will do George Soros Part 4, the Trading Rules for Offense. Wishing everyone peace and prosperity.